So why don't, if we might, start out just by a quick round of introductions, because I think everybody will be familiar, particularly with some of the schemes that you all have responsibilities for. And so, Service, maybe we could start with you. Maybe you could talk just a little bit about Barclays and about the shape of this and some of the challenges that you've faced as well.
Yeah, sounds good. Thank you. The pension fund, the Barclays pension fund is a defined benefit and defined contribution fund, total assets around 25 billion or so. It is a relatively mature corporate pension scheme, and therefore it has clearly shifted its overall asset allocation and its overall exposures over the last 10, 15 years that we have been managing the portfolio. It basically started just like lots of other corporate pension funds out there, relatively low hedging, low interest rate and inflation exposure, primarily exposed to growth assets and opportunities to grow the portfolio. That clearly worked really well. It allowed the portfolio to take risks in places that were more diversified. I know, in hindsight, you can look back and look at the rates where they were in 2010 and where they are now, and you could argue that perhaps, you shouldn't need to hold any bonds whatsoever, but you probably wouldn't be able to afford to be around currently to do that. So the portfolio has changed a lot. I am part of a team of around over 20 people. And what we do is absolutely focus on managing the exposures of the fund, absolutely sticking with the strategic plan for the portfolio, the trustee plan for the portfolio, and then looking to deviate from that and keeping ourselves risk disciplined and honest around that plan when we see that opportunities arise, either structural or because of idiosyncratic events, as you mentioned just now. With regards to more specifically about where our focus has been over the last couple of years, where lots have happened, I would say it has been less on really acquiring market and beta exposure. It's been much more on making sure the hedges in the portfolio, not just interest rate and inflation, but also currency, downside protection, longevity, are at the right place for the overall portfolio relative to liabilities, given this significant volatility. Liquidity has been, probably the number one priority. Skill and alpha, and focusing on strategies which can navigate those environments that, as previous speakers said, we haven't seen for 15 and 20 years now. So this has been incredibly important as well. And when we find the opportunities, rebalance those exposures within the portfolio and alongside that ongoing strategic plan.
Very helpful.
Thank you.
Joe, do you want to talk a little bit about your scheme, and also you've had the perspective of kind of sitting in my chair as well as on the asset owner's chair. So.
Yes. So yes, we're not a scheme. We're very much an asset manager working for scheme owners. Borgicoast is one of the larger pool funds in the LGPS. Our partner funds is 11 of them with about 65 billion pounds of assets. We have about 80% of those assets pooled. We're just across equities, fixed income, and alternatives. We're just in the process of the last major building block, which is real estate. We've done global core and value add this year, and next year we'll do UK real estate, which our partner funds, some of them have very large direct holdings there. So we were set up 5 years ago by a group which had philosophically good alignment in terms of what they wanted. They wanted a well-resourced internal asset management capability, and they wanted to complement that with very good relationships with external managers and GPs as well. So today, I'm fortunate enough to be CIO of an organization with about 85 investment professionals, 120 people in the business in all. And we're managing equities, fixed income, and alternatives directly, and we also do so with third-party managers as well. One of the things I would say that I maybe sets us apart perhaps from other pool funds as well, we're very careful about what we do in terms of launching strategies. We don't want a proliferation of different things. We want to work with our partner funds to bring them together and say, look, what is it really that you want? We only have about 14 distinct strategies today. We tend to have very large allocations, obviously, as a result from that. So we're not really going to go into kind of micro themes and idiosyncratic shocks for us. Yes, we have an asset allocation committee. Yes, we spend some tracking error budget in terms of adjusting portfolios. The information ratio on that is pretty questionable. Given the fact the last 9 months has gone from growth, value back. So it's a bit tricky to have conviction in that. What we have been successful doing is building very long-term secular thematic strategies. So, for example, we just had the climate discussion we just had, ESG climate approach. We did launch a climate opportunities strategy, which was trying to think about not just infrastructure or renewables, but also the technologies that will make money, if you like, over the next 10, 20 years as we get to that transition in 2050. We're also, I can talk about more detail, we're going to do something similar in the UK from a multi-asset perspective. There is an imperative upon us in particular, I think, to think about UK domestic market, which probably doesn't necessarily be the case with other institutional retail investors. So that's something that we're exploring and looking to launch in Q1 as well. We're different. The LGPS doesn't hold an awful lot of fixed income. 7 years ago, about 16% allocation to fixed income. Today, about the same. Across a bit of linkers, a bit of investment grade, and some multi-asset credit, non-investment grade opportunities. I think the area that I think we're seeing at the moment is the continuum on credit is quite interesting at the moment, the dynamic around that. So the discussions around, I've always invested in private credit, but at the moment I'm kind of thinking about get 6% in IG, or I'm getting well compensated potentially elsewhere. Should I really be committing to private debt in the same way? So there's those sorts of discussions, I think, can be more medium term in terms of thought processes on that. We can talk about technology as well. We're doing a lot of work on that side as well, but happy to leave it there for now.
Mike, that's kind of a nice way to contrast some of the things that you've been driving.
Absolutely. Well, firstly, David, thank you to you and your colleagues for inviting me to participate in this panel discussion. And I think the topics that you outlined earlier are exactly in the sweet spot of certainly what's in this CIO's mind. I can't speak for all CIOs, but definitely in this CIO. So just by way of brief introduction, I'm Mike Eakins. I'm the CIO of the Phoenix Group. Who are the Phoenix Group? We're the UK's largest long-term savings and retirement provider. We manage about £270 billion of assets. At least it was about that when I left my desk about an hour ago, and that's where the Bloomberg screens were. Yeah. Given what's happening in the market, who knows where it could be. But most importantly, we manage that £270 billion on behalf of 12 million customers, predominantly in the UK. Not solely in the UK, we've got businesses in Ireland, Germany, Scandinavia as well. But what that means in terms of our footprint in the UK is that 1 in 5 adults in the UK either has a pension contract with us or we're paying a retirement income to. And when we discuss this with our colleagues, in order to keep this real, I like to use the Starbucks analogy, which is when you go into Starbucks in the morning and you queue for a coffee, as I commonly do, and there's 6 people ahead of me in the queue, unbeknown to me and unbeknown to them, at least one of those individuals will be a Phoenix customer. And we take that responsibility very, very seriously. We are a purpose-driven organization to provide our customers with a life of possibilities. But we're also a FTSE 60 company. And so we're not shy about the fact that we can execute that purpose, but also make money at the same time. And some of the topics that we're going through right now, are absolute left-hand tail scenarios. They're idiosyncratic shocks. But also, we would say there are opportunities as well for us to deploy into those markets. And I think all of the topics that my fellow panelists have just mentioned, so I'm not going to repeat them, are absolutely topical. But the whole topic of private versus public markets is still there. It's still, and has got a real role to play. But also, in addition to that geopolitical outlook, is the fiscal outlook. Right now, government bonds look super attractive. Looking at 4.5% over the long term. If we just contrast that with where we were 12, 18 months ago, we're in a vastly different environment. And that absolutely, those geopolitical shocks, the fiscal environment, the monetary environment, absolutely all plays into the decisions that myself and the respective teams make on a day-to-day basis.
Well, maybe we could start a little bit with this view of private markets, and in particular private credit, the blending of private credit and some of the public markets, and kind of how you're thinking about that in the portfolio. And Stavros, maybe we start with you. I know you've given a lot of thought to some of the changes that have happened in this market.
Yeah, I think it's fair to say that things have changed a lot. I think if you go back 2012, 2013, time when kind of roughly 10 years ago when people starting, that CDI, that more cash flow matching, the point when people were comfortable about the risk, the balance sheet risk, if you wish, the interest rate inflation exposure and the overall risk in the portfolio, started looking a little bit more on how do I match those liabilities from a cash flow perspective. We went through a period of 10 plus years with risk-free essentially at zero. We went through a period when essentially we stopped talking about total yield. We were just talking about spreads, right? No one was thinking in total yield terms. Everyone was thinking about spreads. And what clearly has changed over the last 2 years, as just mentioned, is the fact that rates now, risk-free, are at a point when I don't think people could or should think about just spreads. Because the total yield is clearly much more important, because that linear, if you wish, utility is just it can get you into a lot of trouble, as we are currently seeing, with what's happening in the US and the FTX and whatever else. So it is very important that you don't just focus on cash plus and you just keep focusing on the plus. But it's great to hear that clearly government bonds are becoming much more attractive for all investors. And it's interesting, I'm saying that because ironically, they are becoming less and less, if you wish, attractive for, fully funded, fully hedged, very healthy surplus corporate pension funds or other multi-asset portfolios, because already they have a very significant interest rate and inflation risk in the portfolio. And clearly the yield is certainly attractive, but there are all sorts of dynamics which are reducing the duration of the liabilities we're looking to hedge. And there are also all sorts of dynamics which weigh quite heavily on the supply, on the government bond side. And I think that balance makes us a little bit nervous to essentially be, if you wish, overheads, or be at places where we would be having more interest rate and inflation exposure. But clearly, if your starting point is incredibly low, as you suggested, then that's certainly a different proposition. So I think from our perspective, we continue to like and obviously want to earn more money than the risk-free. However, what we're really struggling is the fact that with the credit spreads above, government bonds, whether it's credit spreads on corporate bonds or illiquid credit, with that now being a much smaller part of the overall yield on offer, we just feel that perhaps those more kind of illiquidity, complexity, operational issues, that kind of, the fact that reinvestment risk, the fact that this goes completely away from you. We just don't feel that perhaps you are as compensated as you should be for the time being. Plus the fact that illiquidity is the appetite for liquidity is lower and lower as we go ahead. I'm sure buy-ins and buyouts will pop in very quickly in your...
Maybe just be interesting to compare. So when you think about the role of fixed income broadly and then private credit in that, how have they evolved as you've thought about your portfolio construction?
Look, we really like private credit. We think it has a fantastic opportunity to provide us, well, it gives us a much closer proximity to the borrower than public markets. We're not just buying a bond with an ICE in from a perspective. We're actually got a bilateral relationship in some instances with the borrower. So it gives us a much closer proximity to the underlying risk. We like the fact that a lot of private credit, particularly in infrastructure, and real estate. We've got security against underlying assets in the event of default of the borrower. We also like the fact that we can tailor the cash flows and some of the structures to better fit our liabilities. And that, in turn, leads to a lower capital requirement for us. So all of those are absolute positives. Now, but with private credit, we have to have the in-house expertise to be able to originate these assets, to be able to rate these assets, manage them on an ongoing basis on the working assumption that at some point in time you will be called into workout type of negotiations. But fundamentally, we absolutely view private credit as being a core part of our asset allocation. But what we will not do is chase volumes in private credit. We think that's the wrong way to go about it. So if you look at our activity this year, we've been active in private credit, but actually, what have we been doing? Well, we've been active restructuring existing private credit assets. So saying to borrowers who have got maturities coming up in 2 to 3 years, look, rather than run that pin risk of trying to refinance this asset in 2 to 3 years' time, why don't we agree today a package that allows you to extend that, and then it gives you that certainty to get through the current volatility. So of course, in this current market, you know, we've now got, and I've heard this phrase coined many a times, first by Gordon Brown, the former UK Prime Minister, we are in this almost perma-crisis. We're sort of lurching from one crisis to another, whether it's Brexit into COVID, into some of the geopolitical aspects, the horrific scenes coming out of Russia, Ukraine, the Middle East, the decoupling of the East versus the West. We are in this perma-crisis environment. Now, what does that mean in terms of markets? It means that literally no one's got a crystal ball, because none of us, and I think you said very eloquently earlier, David, has got the crystal ball, and none of us have seen the rule book on how all this plays out. But these episodic periods of volatility for long-only and long-duration investors such as ourselves presents real pockets of opportunity to be able to lock in those incremental yields, but importantly, provide that certainty to the borrowers who crave it. So look, in summary, private market assets, fundamental part of our asset allocation. We really like the proximity it gives to the borrower, it gives us to the borrowers, and really the opportunity to have those long-term relationships over time. We don't view private credit as one and done. We want to get to know the credit. We want to be the lender to those credits on a continual basis. That's really, really important to us, which is why it's really important to us to partner with partners such as PGIM, because that's a key element of it. The longevity, that direct relationship and that longevity of relationship is really, really important to us.
So maybe, Joe, we can pick up on one of Mike's points about, I mean, volatility is not risk. We like to talk about it in that, and all of our vol models would tell us that. But we all know as investors that half the time, volatility is opportunity. And maybe how do you think about all of this if we have a perma-crisis? How do we think about making as much of the opportunities as the risk in this environment, given that you do have a more equity-focused portfolio?
I think, so the portfolio is about 80% in growth assets today. So we don't have any legal requirement, if you like, to hedge. And so we're not in a corporate defined benefit space, so we can benefit from that. We're also, committing capital heavily into the private side, relatively new. I mean, our, as I said, only 5 years old, so we have a lot of fresh capital to come to play. We can benefit from other people's distress. So an example would be real estate. So we can put a lot of money to work in real estate potentially over the next couple of years. I think the discounts available will be very, very significant. I think in the liquid market side as well, I know this is I'm here with a couple of asset managers. There's potentially a dislocation happening where the investment managers could become the investment opportunity. So essentially, if something's going to yield me 6 to 11%, and actually has a decent book of business, including private debt, private equity, could be a good investment as well. So we're looking at those sorts of value plays as well within our portfolios. So maybe shifting away from some of the things that are more focused on long-term optimistic growth environments, and thinking about, well, if we get into this sticky situation, a lot of volatility over the next couple of years, where's going to be the real buying opportunities, things that will sail through this. There'll be issues, But I think there will be good. Here's a guy sitting on a stage saying you should buy banks. But there are going to be very significant pockets of value going forward, because it's definitely the case. You find that this segregation of investors across the volatility view of it, some are essentially pulling back more than others. I think is an opportunity for us. And anything with debt attached to it, and you can't hold debt. Real estate is the best example at the moment.
Maybe just as a follow-on, as our growth investor among the group, obviously there's been a lot of discussion in the UK about the lack of venture capital financing, the lack of technology, a certain amount of gnashing of teeth as inventive companies go to NASDAQ to IPO. How do you feel about some of the Mansion House reforms? How do you feel about progress on trying to address this issue?
So I wish this discussion happened over 10 years ago, because we're a bit late in the day on this one. So whether it's Labour or the Conservatives, they have the same policy, which is they want to see more investment into the UK, they want to see in the public markets, they want to see more IPOs, they want to see businesses choosing the UK, they want to see private market capital creation. The UK is the lowest in the OECD in terms of capital market creation on a domestic basis. So we're not seeing, to this point, proper investment on a private basis. Now, someone can say, well, we see money in EIS and venture capital trusts, but that's really tax optimization for high net worth individuals. We're not actually seeing any institutional investor flows into that space. Right. So obviously the emphasis, well, let's think about where the capital is available to this. I think ISIS is an example. You could definitely have ISIS where you could put 5% additional ISIS and say you have to invest it in the UK. That might be a good thing, whether it's public or private, I'm not sure. I think the problem you get to with institutional capital is UK defined benefit pension plans, 1.2 trillion. That's pretty much a hedged portfolio, and it's moving in that direction. Yeah. Saying to trustees you should buy more UK equities is not going to happen. UK equities now 3 or 4% market cap weight anyway, so it's a minority sport. It's not going to get any bigger there. You can go to insurance companies, but they're on a Solvency II, and the average insurance company has 7% in equities, so they're not going to do it for you. So then you're down to, where else? DC. DC is a real possibility. But the problem is the whole DC market, because of government regulations and others, has been, let's clear this out to the lowest cost provision. Just do it for 5 basis points. That's how you win DC business. And now all of a sudden you're going to say, no, you can put 10% in the private equity. How is that dynamic going to work from a commercial perspective? I think asset managers will love it, by the way, but you leave that aside. So really then you're left to, LGPS, it's about 380 billion of assets. I should say at about the same amount of liabilities, and the average person in the LGPS pension scheme has a pension of about £4,000 and has a fairly modest job. So the idea it's some sort of great sovereign wealth fund that can come in and bounce in and create massive investment in the UK, I think is difficult. That said, Mansion House and the consultation document said let's put 5% into the UK. Very supportive of that. I think there's a lot of potential opportunities in the UK more generally outside of growth and value. Growth and value. That's a bit of a tricky area because it's a tricky area. But I think things like the levelling up agenda, there's opportunities outside of, we're very London-based here, but there's an awful lot of opportunities outside in infrastructure, in real assets and so on. I think that's something that certainly we can see more investment over the next 10 years. I think that would be a very positive development.
Right. Do you want to comment, Mike, on because from your vantage point, obviously this is quite important, but you have all the constraints of the insurance liability back.
Yeah, look, I completely agree with all that Joe has said, and we haven't rehearsed it at all, but 10 years too late. Probably the bit I'd only disagree is it 10 years or 15 years too late. But look, Felix, we were a signature to the Mansion House Compact. So we were one of the 8 signatories who in July committed to invest 5% of our defined contribution assets in private equity, including VC and early stage growth by 2030. That's a tall order. So we got 6.5 years to deploy over 10 billion, well, it'd be probably more like 12 billion pounds in these private assets. We absolutely think it's the right thing to do. Arguably, we'd say is 5% the right number? Probably not. Actually, if you think about lifestyling this, for people who are saving for their pensions in their 20s and 30s, actually arguably they should have more than 5%. But it's the right point to start. Why do we believe it's the right thing to do? Because it benefits UK savers. So today in the UK, there's about £3 trillion of pension assets in the UK. If you combine DC and DB, not including public sector, private sector, £3 trillion. Now, today in the UK, the average allocation to productive assets, like venture capital, early stage growth, clean technology, et cetera, is 9%. If you look across the average of the other top 7 developed market nations, the average is 23%. So the UK is 14 percentage points shy of where the average of the other top 7 developed market nations is. That is absolutely shocking. It's shocking for the return that comes through to our customers, but it's also shocking for the opportunity cost to the broader economy. Now, if you think, the final point on this is the impact to UK savers. So today, we know that over the 10-year period, 2011 to 2021, the average UK saver was 1.3% per annum worse off than his or her peer in Canada or Australia. That, for us, is absolutely shocking. Why? Because it goes to Joe's point that the regulation, which had been dreamt up 15, 20 years ago, had basically a race to the bottom in terms of cheapest chips and not focusing on the long-term returns. We're absolutely adamant that having a modest allocation to VC, early stage growth, is the right thing to do for our savers. And that's why we were absolutely delighted to sign up to the Mansion House Compact. And now we've got the really challenging item of actually deploying that 12 billion. But we absolutely think it's the right thing to do.
I would definitely agree, I think, with the point about this discussion needed to have started 10, 15 years ago. One of the largest allocations within the pension fund is on private equity, and over 65% of that private equity is actually venture, because we consciously made that shift around 2010 or thereabouts. And it is, even the last couple of years, with everything that's happening in the market, it's the highest cash yielding allocation in the portfolio, because we're not investing as much, because it's mature, not investing as much, ripping out the cash flows. It's actually the highest cash yielding allocation. A couple of more other points. I would say it is, totally agree with I guess, DC and other funds being invested in more liquid assets. The bit which I find a little bit uncomfortable when it's all about the return. I think the idea that a private asset, by definition or by rights, should offer you more than a traded asset or a public asset, I think it's likely, and perhaps but you're not going to know until the whole period, and both assets have matured, and perhaps you may be able to make more money on the traded assets by essentially taking into account reinvestment risk and the liquidity that it gives you. So with regards to savers, therefore, I would personally be a little bit more focused on diversified sources of return and risks, rather than if you invest in private, you're going to get £1,000 more in pension in 20 years' time. It's obviously an easier message, do privates, you're going to get bigger pension. But I do find it a little bit as an uncomfortable proposition, because there's no guarantee or any right that if you invest in a private asset, you should be making more money than the equivalent traded asset per se.
But I'd probably also be concerned about asset managers driving into the space, seeing that extra marginal asset base. Are they necessarily the best private investors, or the ones with the platforms? That would be a concern as well.
Very good point. So last topic, technology. As you look out at the investing landscape, there's been some people that do think that we are on the verge of something as powerful as the advent of the internet with AI, and that is going to fundamentally change productivity in many industries. And we've certainly seen the stock market react in some quite amazing ways on this, from chips onto GPT chat. So how are you all thinking about the role of technology in your portfolio, and how are you thinking of playing some of these trends?
So I think it's pretty profound. I think we might be looking at something equivalent to the automation of the auto industry in the 1980s. I think it's going to be right in the white-collar segment. We had a seminar recently with all of our suppliers, asset managers, investment banks, data groups as well. All of them are investing heavily into the space. It's going to impact everything that we do. So we obviously have internal research capabilities. That's going to change. How we deal with our customers, CRM, that's going to change. A year ago, we were talking about corporate lawyers who have 2 years' experience getting paid a lot of money. Guess what? Not so much on a forward-looking basis. So things are changing very, very quickly. I think what I was taken away with is obviously the adoption of the technology has been so quick. So what Netflix took, 2 years to get to 1 million users, and we got ChatGPT in 3 days or whatever. So, and every single entity that we're talking with is resourcing this. But you know what? It's deflationary. It's going to take costs out. That they all seem to have the same view.
Mike?
Look, I completely agree. We do think this is absolutely profound. We do think the advance of AI, not just AI, but quantum computing, blockchain, is going to lead to a surge in productivity. Now, what we're looking at from an investment perspective from different sectors is who are the fast adopters? Who really gets the fact that the rules of the game are changing? Because there's clearly, and we're already seeing it in the tech space, there's going to be absolute winners and losers, not just in terms of the individual names, but we're also looking at this from a sovereign perspective. Given the advances in technology and AI, which countries are now saying, you know what, we need to rethink the way in which we educate our children? Because actually the way we educate our children today is to produce corporate lawyers as one of the most sought after jobs. But as Joe's just eloquently said, that's not going to be the case on a going forward basis. So look, we get to this half glass full. We participated in the AI Summit last week. We were pleased to do so on behalf of the City of London. We do think it's going to lead to a productivity surge, but we're absolutely mindful that there's going to be winners and losers in this, and the winners are going to be the ones who early recognize and early adopt, and the losers are going to be the ones who are left behind.
Stairs, the last word is yours.
Thanks very much. It's certainly a right tail for portfolios, and a fat right tail as well, which we absolutely need to take into account and pay a lot of attention. For us, it's the early adopters, and specifically kind of what are the key sectors where AI will help a lot, whether that's clean tech, whether it's healthcare, whether it's financial technology, whether it's whatever area will use AI in such a way that will bring the highest and fastest, in some way trying to replicate what we did 15 years ago with focusing on venture, try to do a similar thing, focusing our risk budget, our growth risk budget on areas like this.
Very helpful. Good. Well, I think we should leave it there. A big thank you to the three of you for being here, for making yourselves available, and for what I thought was just a terrific, and pretty broad-ranging discussion of all of the issues that we say. So, Sarah, Joe, Mike, thank you very much.
Thank you, David.
Back over to you. Howard?